Imagine you invested in a fund on the first trading day of 2025 that promised to distribute all its returns on the last trading day of the year. The portfolio in this example comprised 30 of the best-known publicly traded companies, equally weighted, and is shown here ranked from best to worst performance. You'll notice that the fund collected about 2.24% in dividends. So if one invested $100,000 in the fund at the beginning of the year, and assuming the fund made no purchases or sales of securities within the period and it passed through the dividends it received, the 1099 DIV would look like this. The dividends would show up in box 1A, and depending on the investor's circumstances, could be taxable. The cost basis of the investment would remain unchanged. But remember that in the example fund, the manager promised to distribute the total returns of the fund, not just the dividends. And our hypothetical fund had 15.74% total returns. Since the dividends alone are insufficient to make that distribution, the manager will need to sell some securities to raise cash. But which ones? If the manager sells the best performing stocks, that would raise cash, but the fund will realize short-term capital gains. The portion of the distributions that came from dividends and short-term capital gains would again appear as total ordinary dividends and may be subject to tax, in which case the 1099 DIV for a $100,000 investment might look like this. The total returns of $15,740 are distributed, but $7,431 of that would be potentially subject to tax as ordinary dividends, and the cost basis would be reduced by $8,309 from $100,000 to $91,691. Because it is an investor's total return net of taxes that matters, a manager trying to minimize the immediate tax burden might instead decide to raise cash by selling losing positions. In that case, there would be a realized short-term loss, and those realized losses might even exceed the dividends the fund received. In that case, the investor's 1099 DIV might look like this. The entire $15,740 distribution, equivalent to 15.74% total returns on the $100,000 investment, would appear as a non-dividend distribution in box 3. In all examples, the fund's total returns were still 15.74%, but the potential tax implication for the investor were different in each example.